Hey everyone, and welcome. Today we're jumping into a GST topic that, let me tell you, trips up so many students. It looks easy, but this is where marks get lost, so let's crack the code together. All right, let's not waste any time. We're going to start with a classic exam-style problem. Look at this, 4 different dates for one simple sale. Now, the big question is, on which of these dates does the government say, okay, time to pay up? Go on, take a guess. Pick a date in your head. You got one? Good. Let's see if you're right. It feels straightforward, but there's a very specific logic you have to follow. And the key to unlocking that puzzle, and a ton of others just like it, all comes down to understanding one core concept in GST. We're talking about the time of supply. So what on earth is it? Well, to put it simply, the time of supply is just the official trigger date. It's the precise moment in time when the GST law says a tax liability is born. It's not always when you get the cash. It's not always when you ship the product. It's the specific date determined by the GST Act. That's it.
Let's start with goods, okay? This is covered under Section 12 for what we call forward charge cases, the normal situation where the supplier pays the tax. Now, you really got to pay attention here because the rule is super specific.
And here's the rule. It's actually beautifully simple. The law just says the time of supply for goods is whichever date is earlier. Is it the date you actually issued the invoice? Or is it the last date you should have issued the invoice? That's the golden rule. Just remember, earlier of the two. So this brings up a pretty important question, right? What is that last date? Well, this is the exam tip you have to burn into your memory. Section 31 tells us that for goods, the invoice has to be issued on or before the date the goods are removed or dispatched. This little detail connects everything. So let's circle back to our original problem. The goods were removed on May 15th. That means the absolute last day to issue the invoice was also May 15th. But the company actually issued it 3 days later on the 18th. So let's ask the question, which date is earlier, the 15th or the 18th? Of course, it's the 15th of May. The time of supply gets triggered on the date of removal, simply because the invoice was late. See, the law doesn't care if you're running behind. It locks in the liability at the earliest possible moment. Okay, so we've totally nailed it for goods. But now, let's switch gears and talk about services under Section 13. You have to be on your toes here, because the rules, well, they're a little different. Take a look at this. For services, the formula has a few more moving parts. We're still looking at the invoice date and the date the service was provided, but look what's new. The date you actually receive the payment is now in the mix. And the rule is the same. It's the earliest of the dates that apply. And just like with goods, that phrase in time has a very specific meaning. For services, an invoice is considered on time if it's issued within 30 days from when the service was completed. Don't forget that 30-day window. It's a super important detail for solving these problems. All right, let's get to the most important part of this entire explainer. I'm talking about the #1 trap that students fall into and the thing that ICAI absolutely loves to test. And it all boils down to one thing, the payment date. I can almost hear you thinking it. This is the thought that runs through so many students' heads. Wait a minute, they got paid on the 25th. For that first problem with the goods, shouldn't that matter? It feels right, it feels logical, but it's a trap. Let me be crystal clear about this. Confusing the rule for payment dates between goods and services is the single biggest reason people lose marks on this topic. This is the moment where you either lock in those points or you watch them float away. And this slide lays it out perfectly. Look at this, side by side. For goods, the date of payment is completely, 100% irrelevant. It doesn't matter. The law was changed to make life easier for businesses. But for services, the payment date is absolutely relevant. You have to keep these two worlds completely separate in your mind. So, how is this going to show up on your exam? Well, for an MCQ, they'll just throw the payment date into the options for a goods transaction just to see if you'll take the bait. For a longer question, they'll be watching to see if you mention the payment date in your reasoning. And for the ultimate challenge, they'll give you one question with both goods and services just to see if you can apply both rules correctly. Here it is, your cheat sheet. Step 1. Every single time, ask yourself, am I dealing with goods or am I dealing with services? If it's goods, I want you to mentally just cross out the payment date. It is noise. It is there to trick you. Then, you just compare the invoice date and the removal date. Pick the earlier one. Done. If it's services, you know that payment date is now in the game, And no matter what, remember the golden rule. The law always wants to lock in that tax liability at the earliest possible moment. Take a good look at this. Dritty Enterprises provides a service on May 4th. The invoice comes out on May 12th. The money hits their bank on June 1st, but they only get around to recording it in their books a day later, on June 2nd. The question is simple. What is the time of supply? Just take a second. Look at those dates. All right, let's do this. Step 1, service date is May 4th. Got it. Step 2, the crucial one, the 30-day checkpoint. Was the invoice on time? The service was on May 4th. The invoice on May 12th. That's only 8 days, so yes, it's on time. Because it's on time, that leads us to step 3. We're on the first path. We need to find the earliest of the date of invoice or the date of payment. So, for step 4, we have to figure out our official date of payment. Remember the mini race? It's the earlier of the bank credit on June 1st and the book entry on June 2nd. So, June 1st wins. Now, for the final showdown in step 5, we compare our two contenders, the date of invoice, which is May 12th, and our date of payment, June 1st. And the earlier date is May 12th. There it is. That's our time of supply. Not June 1st, not June 2nd, it's May 12th. All because that invoice was issued on time. See how that works? Awesome. Now that you've got that framework down cold, let's tackle ICAI's favorite plot twist, something you're almost guaranteed to see in descriptive questions. How do you handle advance payments? Let's walk through this case study. Someone books a convention hall. They pay an advance of 3,000 rupees way back on May 6th. The event itself, the actual service, doesn't happen until September 15th. Then the final invoice gets issued really late, on October 27th, and the remaining balance is paid on November 3rd. Now, this is absolutely crucial, especially for descriptive answers. You have to determine the time of supply for each part of the payment separately. So for that 3,000 rupee advance, well, the payment was received on May 6th, way before anything else happened. So the time of supply for that amount is simply May 6th. Done. Now, for the 12,000 rupee balance, let's do our check. The service was September 15th. The invoice was October 27th. That is way more than 30 days later. The invoice is late. So the invoice date is irrelevant. We have to compare the date of service, September 15th, with the date of payment, November 3rd. The earlier date is September 15th. So for this one transaction, you actually have two different times of supply. Think of this as your exam day checklist. Number 1, always, always, always start with a 30-day invoice check. Number 2, if that invoice is late, the provision of service date is your new best friend. Number 3, remember the date of payment is a mini race. Always pick the earlier of book entry or bank credit. 4, for advances, calculate the time of supply for each payment on its own. And 5, just keep an eye out for that special 45-day rule for banks and insurers.
Okay, right out of the gate, here is a classic ICII-style question. A CA firm pays in advance for goods under RCM. Just take a second, look at the dates, and think about what your answer would be. I'm telling you, a huge number of students get this wrong. Why? Because they apply a rule they know very well, but in completely the wrong situation.
So that question we started with, it isn't just tricky for the sake of it. It's specifically designed to see if you're confused between the rules for forward charge and reverse charge. And trust me, this is a favorite of the ICAI, because it tests if you truly understand the concepts, not just if you've memorized them. Before we dive into the rule itself, let's just take a step back and understand the logic. Why on earth do we even need a separate rule for reverse charge? Well, it all boils down to one simple thing: a shift in who's responsible. You see, in a normal transaction, the supplier collects the tax from you and pays it to the government. So the timing, the time of supply, is linked to things they do, like issuing an invoice. But in reverse charge, the whole thing flips. You, the person buying the goods, have to pay the tax directly to the government. So it makes sense that the law needs triggers based on your actions, right? Not the supplier's. That's the whole game right there.
So how does the law handle this? It gives us Section 12, subsection 3. But look, don't worry about the section number. For the exam, just think of this as your simple 3-point check. It's an easy checklist you can literally use every single time to nail the right answer.
And here it is. For goods under RCM, your time of supply is the earliest of these 3 dates. Number 1, the date you actually get the goods. Number 2, the date you pay for them. And number 3, the 31st day from the date of the supplier's invoice. Just be careful, it's not 30 days. It's the day after 30 days. And the most important word on this slide is earliest. We're always looking for what happened first.
Now let's zoom in on that date of payment because it has its own little mini rule. The date of payment isn't just one date. It's the earlier of 2 things. Either the date you record the payment in your books of account or the date the money actually leaves your bank. You can bet the ICAI will give you both dates in a question just to check if you know to pick the earlier one, so watch out for that.
All right, enough theory. Let's put our 3-point check to work with some examples that feel like they're straight out of the exam hall. This is where the concept really solidifies.
Okay, let's look at this first case. Let's run the check. Checkpoint 1. Date of receipt of goods is May 12th. Got it. Checkpoint 2. Date of payment is May 30th. And checkpoint 3. The invoice is dated May 4th, so the 31st day from then is June 4th. Now, just compare the 3 dates, May 12th, May 30th, and June 4th. Which one is the earliest? Easy. It's May 12th. So the time of supply is May 12th. Simple as that.
Now look at this second scenario. This is a great one. The goods are received on June 12th, payment is way later on July 3rd, but the 31st day from the invoice date was all the way back on June 4th. So when we compare the three, June 4th is clearly the earliest. This is the perfect example of why you absolutely have to check all 3 points every single time. You can't just stop after the first or second one.
Okay, this is it. This is the moment we've been building up to. This is the single biggest point of confusion, the #1 mistake that costs students marks on RCM, and it's the absolute key to solving that question from the beginning. So please, pay very close attention right now. On the left, you see the rule that everybody knows and loves. For goods under forward charge, thanks to a handy notification, there is no GST on advances. You only worry about tax when the invoice comes. We're all comfortable with that. But, and this is a huge but, look at the right side. For reverse charge, that relief, that notification, it does not apply. It's gone. If you pay in advance under RCM, our date of payment rule kicks in immediately. You have to pay GST. Let's just let that sink in for a second. This is the core of it all. That relief, that no GST on advances rule, is only for forward charge. Forgetting this is the trap. In the world of RCM, if you make an advance payment, that triggers an immediate GST liability. Period. So, let's circle all the way back to that first question. The advance was paid on April 10th. The goods came later on May 5th. The 31st day from the invoice is sometime in June. So if we apply our 3-point check, what is the earliest event? It's the date of payment, April 10th. The time of supply is April 10th. The trap was thinking that the no tax on advance rule applied here. It doesn't. Under RCM, the advance payment is the taxable event. Okay, let's recap it nice and quick. First, always use the 3-point check. No exceptions. Second, the time of supply is always the earliest of those 3 dates. Third, and this is the big one, the exam trap. The no GST on advances rule is for forward charge only. For RCM, if you pay in advance, you pay GST on that advance. That's it. That's the entire concept right there. So there you have it. You are now totally prepared to tackle any question on RCM for goods. But it gets you thinking, doesn't it? How does all this change when we're talking about services instead of goods? The logic is pretty similar, but that 30-day limit we talked about, it becomes 60 days. Just something to keep in the back of your mind as you continue revising. Thanks so much for watching.